The tech-heavy Nasdaq 100 recently dropped 10% from its highs, officially entering correction territory. It's a jarring pullback, especially when you consider that the tech companies dragging it down have generated massive earnings growth and maintained some of the highest profit margins in the world. Look at titans like Oracle, Amazon, and Google. Their credit fundamentals are solid, yet the price to insure against these specific companies defaulting has recently hit record highs. This insurance takes the form of credit default swaps. It's a financial derivative that investors buy to protect themselves in case a massive corporation fails to pay its debts. So we have a contradiction. Why are the world's most cash-rich, profitable enterprises watching market pricing flash warning signs about their long-term solvency? This panic is starting because the years-long everything rally is on a collision course with two massive simultaneous supply shocks. One is building inside tech server farms, and the other is legislated in Washington. To build AI infrastructure, hyperscalers are changing their funding. Instead of equity, they lean heavily on debt. This enormous supply of credit floods the market, outstripping demand. The result is widening credit spreads, which spikes borrowing costs for these tech companies. Inside Silicon Valley, tech leaders treat this as an existential race. The prevailing belief in the labs is that they must accumulate as much computing power as possible, regardless of the immediate financial burden. Wall Street, however, is asking a much simpler question. What is the actual price of all this compute? Investors want a clear timeline on when they will see higher profit margins from these specific AI investments. This massive wave of newly issued debt forces a reckoning. The immediate costs of AI infrastructure must finally be weighed against its future revenue. Meanwhile, a completely separate supply shock is hitting the broader economy. New Section 301 tariffs have kicked in, imposing a 10 to 12% tax that covers 99% of U.S. imports. These policies are drafted with a lawyer's mindset, treating international trade as a zero-sum battle where you punish an opponent to win damages. An economist looks at the exact same global trade as positive-sum collaboration that lowers prices for everyone involved. The mechanics of a broad tariff operate as a textbook supply shock. By taxing thousands of imported components and raw materials, it raises the baseline cost of doing business on a global scale. When businesses face higher production costs, they typically pass them to consumers, creating persistent upward pressure on the price index. We are seeing that friction translate to prices right now, with inflation stubbornly hovering around 3.5%. Because the Federal Reserve's target is 2%, this persistent inflation forces their hand. They are compelled to hold interest rates higher for much longer than investors initially anticipated. This closes a vicious loop. Remember those mountains of debt tech companies are taking on? Sustained high interest rates make servicing debt more expensive. High borrowing costs for AI infrastructure, layered on top of tariff-driven inflation for consumers, creates a toxic environment that strains corporate balance sheets. For decades, the easiest way to protect your money was the 60-40 portfolio, holding 60% stocks and 40% bonds. But that safe haven is fading because the AI trade has deeply infected every major asset class. AI companies now dominate the top tier of public equities. The new public credit issuance is driven heavily by hyperscalers, and in the private market, nearly 87% of all venture capital is now directed squarely at AI startups. To survive, investors are adopting a new strategy, deliberately diversifying entirely away from artificial intelligence. They are pivoting out of speculative growth narratives and moving capital directly into value investing. This means seeking out economic safe havens disconnected from the tech bubble. That includes the mid-cap companies in the S&P 400, private credit funds, and global commodities. The market is currently acting as a filter, stripping away ideological visions of AI utopias or zero-sum trade wars, and demanding proof that these strategies can pay the bills in a high-inflation, high-interest reality.